Hello, everyone. Hope you guys can hear me well. Hello, Brian. Hello, everyone. Alrighty. It's good to be back. It's great to be back here and see you all in here. We are also streaming on X. So if you are on X, uh, you can also join the Google Meet if you want to join the discussion. Otherwise, you can listen in, post some comments, and we'll make sure to bring it on. Okay, so today's call is a bit more operational, a bit more reflective, grounded in what's actually happening right now across the market and the protocol. Over the past few weeks, we've seen a combination of continued pressure across DeFi yields, a few notable risk events across the ecosystem, very unfortunate as always, and internally a lot of iteration around how we manage capital incentives and governance. So today is really about stepping back as well and asking how are we adapting to current conditions, not just in theory, but in practice. We'll walk through the state of the market, recent incident and how it was handled, what we are learning from the DAO risk managed vaults after 2 months in. After 2 months in live, and we'll open up, of course, a discussion around incentives and emissions going forward as well. As always, feel free to jump in, challenge points, add context. This call should be as interactive as possible. So let's start real quick with the state of the market. Let's start with the broader market context here, because everything else builds on top of this. If you zoom out over the past month, one thing becomes pretty clear. We are still in relatively compressed yield environment. Across lending markets, whether it's Aave, Morpho, Spark, base yields have remained relatively low. Borrow demand just hasn't picked up in any meaningful way, and the leverage across DeFi is still subdued compared to earlier cycles. At the same time, capital is still moving, but it's moving more cautiously. We can see a shorter duration positioning, less aggressive rotation into higher risk strategies, and generally more sensitivity to risk events. And I think the last point is important because over the past month, we've also seen a number of incidents across DeFi that reinforce something we have talked about before. Yield is never just a yield. It's always risk-adjusted yield. And in environments like this, where base yields are low, the temptation is to stretch for higher returns. But that's also exactly where things tend to break. So from a lazy summer perspective, this creates a bit of a tension. On one side, we want to remain competitive. On the other, we need to stay disciplined in how we take on risk. And that's really where a DAO risk-managed vault framework becomes interesting because it allows governance to express conviction without forcing the entire system to take on that risk. Before we move on, I would like to invite also a block Analytica. I believe you guys, I see Miller joining the call. Maybe I'm just going to give a brief kickstart to this discussion. I want to talk a bit about the recent incident and what we can learn from it. Over the weekend of April 2021, there was a broader issue in the ecosystem related to Kelp, DAO, and associated markets. And while Lazy Summer wasn't directly exploited, there was indirect exposure through one of the or a couple of the Morpho markets, specifically via assets like HJ ETH and RS ETH. So what matters here is not just the exposure itself, which was relatively limited, but how the system responded. Within about 40 minutes of identifying the situation, there were actions taken, and I think Miller will talk more about that. I want to maybe bring in the perspective of the Guardians, where Guardians of the Lazy Summer protocol proposed and executed a transaction to set caps to 0 on affected markets across the DAO risk-managed vaults. Communication went out across internal channels immediately, and then following up on external ones as well. Second transaction followed shortly after to pause deposits into the ETH DAO risk-managed vault. Importantly, withdrawals and rebalancing remained active the entire time, and that was a key design choice, because it meant that keepers could continue to withdraw liquidity as it became available instead of freezing the system entirely. Over the following 24 hours, keepers actively monitored liquidity, withdrew funds opportunistically, and ultimately exited the position. So stepping back, there are a few important takeaways here. The response time matters, and here we are talking about sub 1 hour execution for both key actions of the Guardians. And second, having clearly defined roles, like Guardians being able to reduce caps, but not increase the risk, really helps in moments like this. And third, system design matters more than reaction speed alone as well, because the ability to keep withdrawals active is what actually allowed the recovery of the assets. So here I would love to bring Block Analytica, if you are on, and from your perspective, what are the key decision points during the incident? If you don't mind sharing maybe a little bit more about the incident, your perspective. Is there anything also that you would like to refine or improve in how the system responded? Yeah, general feeling about the recent events. That would be, I'll appreciate it. Welcome, Miller.
Yeah, thank you very much. Good morning, good afternoon, everyone. So basically, like regarding the incident that happens around the April 18th of this year, it was mostly like involving the Kelp DAO, basically like RS is. What is interesting of these assets, basically this exploit, which was basically due to a hack that could mint like several of these tokens, like several of millions, by using like like compromising basically like one of the multi-sigs or keys that were managing a breach, like from 0 layer. What I think the real problem here, it was that this asset was very much incorporated in many of the lending protocols, like including like blue chips as Aave, for instance, Aave V3. So that's why it was like very important, or like, let's say, had a very high impact into the lending like markets. So when we detected the exploit via X, basically, once it was like, posted that there was some minting going on. So what we basically started doing was to look for what is the exposure of the Lazy Summer to that asset, and also like to indirect exposures, meaning that other protocols that are also exposed to it. Then we detected like as Aave V3, which we consider basically like a blue chip lending protocol. There was also Compound, which also we consider like one of the most resilient and like, risk averse kind of like lending protocol. But also then the contagious to some Morpho vaults, some other like ARCs, especially for instance like Fluid Light and other fluid markets. So basically, this was like, I mean, this lead us to the decision to set caps to zero to those arcs, but also like inform the team of Lazy Summer so that keepers can speed up the process to withdraw from those arcs as soon as possible, because as soon as it's late, so then there will be no liquidity anymore to withdraw. So that's why we had to act very quick. So we try to do all the communications as soon as possible with the respective teams. And then, of course, like hoping that all the liquidity could be like, withdraw from there. We were monitoring the available liquidity. And then, like, luckily for us, like most of them could withdraw. The only one that it was still remaining and it is still remain exposed is Fluid Light, which, like, as maybe everybody knows here, is like they provide like leverage looping positions through different lending protocols, including Aave and Spark. And then because of this looping leverage position, so even on a small exposure, it can become like quite big. But then back in the days, let's say the allocations on that arc was around like 45% more or less of the TVL of the fleet, of the high risk E fleet. But then now it has been down to 20%, but also like within this exposure, there is also like, of course, like the exposure to the Kelp DAO incident is like even smaller. But yeah, so we have seen some progress in the last week, like some withdrawing process from the keeper, which is good. But yeah, so I think like coming to the second point on what we have learned from this one, and I think what we need to learn, and we always try to make awareness about it, is the first of all, as basically many of the members here mentioned, I mean, there is no reward without risk, so everything's like risk adjusted. But also like you cannot consider even like blue chip protocols like risk free. So we also need to monitor them like Aave, Compound, etc. But in also, let's say, what is important is to be aware of like those arcs that has like limited liquidity for the withdrawal. So, or like those arcs that has always like, like some queuing process, like you can only withdraw within the next 48 hours or this kind of things. Every time we need to review or like, like try to give a recommendation on one of those yield sources. One of the things that we always notice is like if whether this yield source will allow for instant withdrawal or you will need to go through a queuing process. And if there is a queuing process, if there is a fee, right? Because as we know, Lazy Summer is a rebalancing protocol, so it will be like regularly withdrawing and depositing. And then we always notice like for a couple of yield sources, like, we can name them like, like the latest has been like Maple, like Fluid Light, also like others, like, like when traps are set to zero, we already know that the keeper cannot withdraw immediately because the mechanism behind those yield sources is not for instant liquidity withdrawal. So, and this is something that we always try to make sure we mitigate the risk. For some of those arcs, we always have like very conservative caps because of those reasons. And this incident, for instance, showed one of those cases, right? Which we could like withdraw from all the exposed arcs except from one, which we are still on the process. But then it's look good for the community to always be aware of it. Like whenever we see a yield source that, even if there is like a very high APY for rewards, and we may set like some conservative caps, it's probably because there is some queuing process into the withdrawals. And if such events happens like the ones of the 18th of April, so then, I mean, there will be assets, like there will be stacks there, and we don't want that, right? So yeah, so I think this is like maybe like one thing to keep in mind, to learn from it, and also to be aware of. And yeah, and then right now, of course, we are still monitoring the situation. I don't know, as many of you know, Aave has set up also like a fund for paying some sort of like bad debt that is happening there. There is some like process ongoing. And then as soon as we see that everything is like clear, like, like the incident has already passed and there is no any other collateral damage or anything, so we will probably start like revising the caps again and then setting them up above zero. So yeah, that's it's like one comment from our side.
Thank you so much. Thank you so much for this report. It's always great to hear from you guys, and yeah, I believe we have all like sort of been watching very carefully at what this how this impact can or how this incident can impact essentially the whole ecosystem, how is best to react as well, how to make sure that the rebalancing are happening at the same time the liquidity as liquidity comes that it's rebalanced. I believe there is still within the ETH DAO risk managed vault there is an allocation into fluid, but that is being like again as you mentioned also actively monitored for the keepers. So when liquidity becomes available, this will be withdrawn or part of it will be withdrawn to a buffer to restore the instant liquidity. And I think even if we zoom out even further, it kind of dives directly into the ongoing quorum discussion as well, because governance parameters, quorum thresholds, they're not just an abstract numbers. They also define how quickly and safely the DAO can react in situations like this. So as we think about increasing quorum or raising thresholds, the question becomes how do we improve security without slowing down responsiveness? And maybe we can get back to this a bit later. I thought to maybe now, as it also ties quite directly to a DAO risk managed vault, to shift the focus over there. Now that we are about 2 months in. Seems like when the Lazy Summer DAO introduced this framework, the idea was pretty clear: is to make this separate DAO risk created strategies from the block Analytica risk created ones, and give a DAO a way to express higher conviction positions within defined limits. Now, after 2 months, we are starting to see how that actually plays out in practice. Here, Jordan, if you are on, I would love your take here. What maybe have been the biggest learnings so far from the DAO risk managed vaults? Where do you think we still need to improve? Whether that's tooling, governance flow, or strategy selection. Yeah, I would just like to hear some of your general thoughts about the DAO risk managed vaults and yeah, being 2 months in.
Yeah, sure. Can you hear me well?
Yep, I hear you perfectly clear.
Yeah, so I think that it's really tailored maybe three key things. So first thing, let's start with the positive maybe, is that yeah, I think it works as expected. It's a higher risk, higher reward, access to the best sort of best performing strategies in DeFi. And I think it's certainly done that. It's certainly given people exposure to that, um, which is great. And I think that it sort of dovetails into the other two things, which are not as positive, which is one, the sort of broader liquidity crunch or bear market, or the lack of capital that has been in DeFi or has been going out of DeFi. If you just look at the sort of DeFi TVL chart, that has always been correlated with the sort of broader lazy summer TVL, and I think it has a finance term like a higher beta or a very much stronger correlation to things that are a little bit out on the risk curve. So something like the DAO managed vaults that are quite out on the risk curve is going to see even less or TVL or even more outflows of TVL than just broader sort of DeFi. So that's a sort of negative thing. It's kind of like a really terrible time to launch, I think, or for it to have gone live. It's really a sort of bull market tool, so to speak, where people are less, I think, less judicious around where the yield sources are coming from. There's the sort of Warren Buffett quote around like, when the tide comes in, you see who's kind of swimming naked. And I think everybody is a lot more cognizant of that during a period like this. And then I think that dovetails into the last point, which is I think broader in like the broader scope in DeFi. Everybody, well, I don't want to say in such broad terms, but or such general terms, but most people, I can speak for myself even, are calling into question some of the most tried and true, not only yield sources but even protocols. Aave, for example, the Ethereum Foundation put in 20,000 ETH into Aave under the assumption that this is extremely low risk DeFi yield, and that was obviously called into question last week to a degree to say, hey, are we even going to get 50 cents on the dollar of principal, let alone just yield? So, with that, I think that's another sort of sticking point with respect to the DAO managed vaults is if you can't even trust, for example, or things like that, then it calls into question SUSDS. It calls into question other really, really, really blue chip DeFi yield. So I think it really makes it hard for capital to come into things like the DAO managed vault. So I think that's the state of the situation today. But I think that my you know, personally, learnings, things like that. I think the product itself is good, and I think the value proposition itself is good. And hopefully, if well, yeah, I think hopefully if everything is still in place when the next bull market comes, if the next bull market comes, which I think it will, as it usually does, then I think it's a great product to have in the back pocket, to satisfy that need for risk taking that I think will inevitably come back. So yeah, those are my thoughts. A little bit long winded, but I think it hits all the key points, and we'll have to figure out how to maneuver from here, basically.
Thank you so much for this overview as well. Yeah, if I had to summarize it from my side, I feel like the framework works here. Maybe coordination is part of the challenge here as well, because giving governance more control also means more responsibility, more need for clear signal, and better alignment across contributors. I'm super grateful to have this framework around the DAO risk managed vaults created by the Block Analytica as well, which makes it that much easier to follow when proposing new strategies. And yeah, I'm also very positive about the product, and I'm really looking forward to when the waters will settle down a bit more, and hopefully will the whole ecosystem will just become ever more so strong on the other side. All right, maybe this also quite ties quite nicely with the incentive design discussion, which we had in plan for this call. This is something we have been iterating on for a while now, and it's becoming increasingly relevant in the current market environment. The core question here seems to be, how do we remain competitive, right, on the yield, at the same time without relying on unsustainable emissions. So right now, summer rewards are still playing a meaningful role, in my opinion, in supporting the APY, in attracting and retaining capital. But at the same time, emissions come with a cost, and over time they need to become more targeted and efficient. The current proposal is already moving in that direction. There is a slight reduction in overall emissions, more focus on high traction vaults, and potentially offboarding low usage vaults entirely. And I think that both of these last points are quite important, because it reflects a shift from sort of supporting all of the vaults to focusing where it actually matters. Chris, if you are on, would be great to hear your perspective as a proposer of this RFC here. How are you thinking about the balance between the competitiveness and the sustainability right now? What do you think should delegates prioritize when evaluating these changes?
Certainly, and thanks also to Miller and Jordan as well for the comments before and stuff on the various kind of the risk and then the kind of outlook on the DAO managed vaults as well. But I think for these vault missions, obviously this ties closely into the other proposal in there as well around potentially offboarding a number of markets as well. So this RFC that I posted yesterday, the extend and adjust vault reward emissions, is if you see on there, it only proposes adding rewards for ETH, Ethereum based vaults and base vaults as well. So this in some ways makes maybe some assumptions that the other vaults would potentially be offboarded on there, but even if they're not and they remain, perhaps just maintaining the summer rewards on these vaults. Basically, the issue we've got, I think, as a community is obviously the summer price is much lower than we would all like and hope it would be, particularly given where the market and stuff is at the moment and where kind of DeFi general appetite and growth is at the moment. So we need to kind of make the best use of these summer rewards, in my opinion, around that. Now, if we try and split the rewards across all the available vaults, although the TVL and the other vaults that are proposed to be offboarded are quite low, it still takes away summer. So your kind of average APY that we're targeting ends up being reduced across all vaults, potentially even to a not pointless number, but a value that makes no material difference to people's decisions to lend into that vault or not. So in here, what we tried to do in the proposal is basically target around a 0.65% or 0.64%, I think it was, value on there, with one or two of the vaults kind of being pushed up slightly to meet a minimum requirement on Merkel's side of 6,000 before we just have to pay some of the distribution fees on there as well. So generally what this does is it focuses on the most used vaults across the Lazy Summer protocol, the ones that have got actual traction, are getting usage, do continue to have deposits and so on made into them, and so on, and the ones that I think are most likely to grow. Obviously, with this proposal and the offboarding proposal, effectively it means removing summer rewards and potentially offboarding the vaults from Hyper EVM, from Arbitrum, and from Sonic. I think Sonic as a network has been dying a kind of slow and painful death for a while now on there. I think Hyper EVM is kind of very sad to see it go. And I should add that when these vaults are offboarded, they're effectively just paused. In the proposal, the offboarding is effectively just setting the deposit cap to 0 and disabling the keepers. So we request that Block Analytica to ideally identify maybe one market, or maybe even just leaving it in 2 markets, but probably better to be one that all the capital is just left in, so it's at least gaining a yield, but the fees are also turned off, so it's always earning a yield. And although it'd be sad to see the Hyper EVM ones, let's say, paused for now at least, because they had a very good, very positive start. We saw them very quickly grow to several $1 million each on those. They then quickly fell away again, particularly as some of the issues in DeFi and stuff kind of started to show and so on. The Arbitrum one has struggled since the Stables Labs, kind of the same time as the Stream Finance in November last year, and some of the issues around that. So yeah, right now this leaves just the 2 main networks where we have seen the most traction throughout all of our vaults over time. But yeah, leaves the USDC, EURC, and ETH vaults on base, and then the ETH and USDC vaults in various forms across Ethereum as well. So yeah, this proposal reduces the total distribution of summer down by around 6% compared to the previous quarter. That was also reduced, I think, by a percentage or 2 from the quarter prior to that. So we are slowly reducing the amount of summer rewards to make it a little bit more sustainable. But yeah, it does only add on around about 64 basis points of yield onto there. But again, keeps it maintained somewhat competitively. Again, this is open for RFC. The intention is to go to vote next Wednesday. I think is the 5th or 6th of May. So yeah, we've got a whole week, I think, open for discussions, and then it got for the actual SIP the week after, along with the offboarding as well, because the current rewards end, I think, the 10th of May on there. So yeah, not sure if anyone has any questions, but that is where they are. If you've got any thoughts, please do add them to the RFC. But yeah, this is the proposal that's currently up, but by no means final.
100%. Thank you so much for this. I also wanted to point out to everyone listening in, please do go to forum.summer.fi and check on these two proposals. So the ones that we are that Chris was also mentioning here is an RFC to extend and adjust vote rewards emissions, May 26, and an RFC to offboard low usage votes across Hyper-EVM, Sonic, and Arbitrum. The votes that are in discussion here. Also, thank you so much, Chris, for putting the polls in as well, which makes it even easier for delegates to sort of show their support. Or share them, of course, any comments to to continue on this topic. The votes in the proposal to be potentially offboarded, or the ones that you proposed, just to recap again, are the Hyper EVM, USDC, and USDT, which as of 27th of April had a cumulative TVL at around $80,000, the Sonic USDC with around 45,000, and Arbitrum USDC and USDT being at $44,000 and $69,000 respectively, totaling around 242,000. When it comes to the rewards, these are across the Ethereum and the Base network, and we are looking there to see what sort of adjustments would make sense. So thank you so much for giving us a rundown on these. And Brian, please go ahead. I see you put up your hand.
Yeah, just a quick question in terms of offboarding the vaults on like Arbitrum and Hyper EVM. As for Sonic, I agree with Chris that it's it's not looking too great in terms of overall chain TVL and so forth. But Arbitrum and Hyper EVM could still prove to be high like high potential chains when it comes to DeFi in the next few years. We are kind of in a bear market right now. So just curious, if I know the vaults will still be there, it's not like we can delete them. Is there like a plan to maybe reactivate the vaults in the future? Maybe let's say if activity, some measure of activity on Arbitrum or Hyper EVM picks up, maybe. Just thinking that maybe not now, but there might be some innovative, perhaps yield sources, DeFi use cases on these chains in the future.
Yeah, so 100%, and that's kind of what when I referred to them at the end about just being paused is we can literally just reactivate them just by increasing the deposit caps and effectively just re-enabling the keepers. So working together with the risk manager Block Analytica to re-enable the exposure caps on relevant markets. It possibly or may need new ARCs deploying on it as well at the same time. But yeah, the vaults themselves won't physically be paused or anything like that, because we'll need the keepers to be able to potentially still get out of a market if it needs to, should something happen with a market that gets slipped into. Like we would have said 2 weeks ago that we could just leave all the funds in Aave as effectively the risk-free rate. But as we've seen, that if the vaults were paused, the keepers then wouldn't be able to withdraw capital from that market, and so on. So we won't pause the vaults fully. We can just set the deposit caps to 0. Users continue to be able to continue that are in the vaults, continue to earn a yield from the market they're exposed to. Like I said, we'll turn the fees off, but we can just effectively reverse all of those options, turning the fees back on, and taking it from there basically. So yeah, if the markets change, if they Arbitrum and Hyper EVM start to show some solid things and solid demand for vaults for these sorts of vaults again, they can easily turn back on. But right now we're not seeing much. I think you put it really well in the forum. Like there is no kind of product market fit right now in the current market. There was when we launched, and last year Arbitrum in particular showed very strong product market fit. for the types of users the vaults are focused on. But right now it's not. As Jordan touched on, a lot of people, the capital is leaving DeFi right now, and yeah, I think it's good just to focus on these vaults. There is one maybe slightly more controversial offboarding proposal vault in there as well that I forgot to mention before, which is also USDT on Ethereum. I think so far it's got 2 votes for no, so rejecting the offboarding of that, which is also fine. But yeah, I put it up there just simply because it hasn't got much activity recently, and compared to the other Ethereum mainnet vaults, it does have a very low TVL relative. But yeah, to your original question, Brian, yeah, they can all be re-enabled as soon as we start to see some like kind of more positivity in the market again, and think they can offer a solution that they give.
And just to add, in terms of the USDT vault, there has been like stigma around USDT for the longest time, but I think they are pushing. The tides are moving back in its favor with the drift hack where Circle didn't do anything. So fingers crossed, we might see some, added activity on USDT now that people are, maybe people will have more trust in USDT, and they are also planning to, recruit one of the big 4 accounting firms. So maybe, we'll get more people in USDT, but people usually prefer USDC because of Circle's reputation and transparency and all these things. So, but either way, USDT is still bigger in terms of market cap. So maybe just usage in DeFi is not great, but hopefully we see some type of rotation.
Yeah, agreed.
Yeah, these are very, very interesting times indeed. I feel like also I can see and I agree with Brian here. Looking at Arbitrum, I think it still has a potential to sort of perform well on the DeFi scene. At the same time, we can clearly see this broader sort of Ethereum ecosystem move back to the L1. It's really interesting to observe, and I think design-wise, it's really great that if there is not sort of enough use for a specific vault, putting it on pause while whoever is still allocated or exposed or deposited into the vault, they still earn some yield, but they are not going to be actively developed until sort of new strategies become sort of interesting to be added, and they can be re-enabled. And I think that's super cool. It really feels like it kind of ties back to how we define success, I guess, as well as a protocol. Is it sort of maximizing short-term TVL, or is it building something that can sustain itself over multiple cycles? And realistically, it really has to be both. But weighing between these two shifts depends always on the market conditions. If there are no other further comments, I would, since we have still some minutes left, I would maybe like to squeeze in and add quickly on the governance parameters, since this is still under discussion on the forum. I'm specifically talking about an RFC about adjusting governance quorum and proposal threshold. If you haven't, please head over to forum.summer.fi and find that proposal, review it, put some comments in. But basically, what is the main point here of this proposal is to make sure that the governance also scales safely as voting power concentrates. Right now, a small number of delegates can have potentially outsized influence on outcomes, definitely when it comes to a quorum. So the proposal is to increase quorum requirements and potentially also proposal thresholds. But again, there's a trade-off, right? Higher security, more coordination required, lower friction, sort of faster governance, but higher risk. So I think if you haven't engaged on the forum yet, I would strongly encourage you to do so, because this is one of those decisions that also helps to shape governance long term. All right. If there are no questions here from the community, I'm just quickly checking on the Twitter as well. Seems like I can't really see any. So maybe we can wrap up slowly. What stands out about the past few weeks is that we are operating in a much more real environment now. It's not hypothetical. It's not a design phase. It's live conditions where markets are slower, risk is more visible, and decisions have immediate consequences. And in that context, what we are seeing is the system being tested and holding up. Whether it's the way risk was handled during the recent kelp incident, as we spoke about before, the way DAO risk managed bots are expressing the strategies, or how we are thinking about incentives and sustainability, this is what it actually looks like to move from designing to operating. I think the question to take away from this call going forward becomes: can we maintain this level of discipline as we scale as well? Because it's one thing to operate well at this size; it's another to do it with even more capital, more integrations that are coming, and more complexity. And that, as mentioned before on previous calls, that's really what the year 2 is about. So if you're a delegate, contributor, or active community member, please stay engaged in the forum discussions, share your perspective on incentives and governance changes, and continue challenging assumptions, because at this stage, the protocol isn't shaped by a single proposal, it's shaped by consistent participation. Yeah, so with that, thanks everyone for joining the call. I appreciate the discussion. Thank you so much, Miller, for joining us. Thank you, Chris. Thank you, Brian, and everybody else who joined in discussion. Thank you, Jordan, as well. As always, I appreciate the open discussions here, and I'll see you on the next call. Thank you, guys, and have a lovely rest of the week.